Hello, everyone. Thank you for viewing our presentation. We are Fortitude Shoe Supply. The members of our management team are myself, Kristen Ortiz, Pat Shannon, and Vincent Walton. We are guided by our CEO, CFO, Joseph Gonzalez. Our mission at Fortitude Shoe Supply is to provide the world with well-built footwear and to supply our customers with high-quality designs. Fortitude's vision is to be a leader in the global athletic wear market and to set a high precedence for environmental standards while also providing our clientele with a superior performing shoe. We look forward to utilizing technology to be at the forefront of the athletic wear industry. As indicated by our mission and vision statements at Fortitude Shoe Supply, we consistently strive to provide great customer service for our consumers. Part of that means that we provide our customers with a great selection. We offer 500 models across the globe. Our products are sold in 4 regions: North America, Europe, Africa, Asia Pacific, and in Latin America. We employ sales representatives located in our regional offices to call retailers and negotiate with them to carry our brand, solicit orders, and to assist us with merchandising and in-store displays. We sell directly to our consumers as well through our internet segment. Our internet segment allows us to directly interact with our customers regardless of where they're located and to provide them with the convenience of online shopping. Fortitude has seen great results from our private label operations as well. We contract with other organizations to use our available unused production capabilities to provide them with the opportunity to sell our products under their own label. Our target market are athletes of all types, including the casual shoe wearers who are willing to invest in a high quality shoe. Because of our high number of available models and our global presence, we are able to reach our target market. We've been deploying a product differentiation strategy by furnishing high quality footwear with a high number of available models. We work towards creating brand loyalty by the progressive, steady increase in quality performance. Our use of superior materials and high ethical standards has increased our brand image. Through our high brand image, we hope to avoid substitution of our products. As evidenced through this slide, displaying the most recent year of our business, Organizations B, which is Go the Distance, and Organization C, which is Champions, have been our closest competition, attempting to mirror our business strategy. However, our overall performance has led us to outperform both companies and to achieve first place in the overall simulation. I will now hand it off to Pat to discuss our products, market share, sales and promotion strategy, and our corporate responsibility. Pat?
Thanks, Kristen. On this slide, we're showing how Fortitude Shoe Supply has priced its footwear against the industry averages in all 4 regions that we sell to. So for key takeaways, you can see that we've always marked up our internet price at 40% above the wholesale price to maximize our margins on internet sales while not scaring away any potential wholesale opportunities in the future. Another thing that was mentioned earlier in this presentation is that our target market is customers that are willing to invest more in their footwear for a higher quality. So as you can see from this slide, we have consistently priced ourselves higher than the industry average. However, we have also maintained a higher SQ rating than the industry average. In fact, if you look at year 19, our 8.7 SQ rating is the highest in the industry. So that justifies, our decision to price our footwear at a higher rate. But in reality, if you look at it through the lens of, okay, how many dollars are we charging per SQ star? we are indeed about $5.26 below the industry average. So we are pretty competitively priced. And that's one of the reasons that we've been able to maintain our market share, even as other competitors have moved into our corner of the market as their SQ ratings and number of models available have expanded in the later part of the game. If we go to the next slide, we can take a look at the market share. So we have 7 competitors in the industry. So the average market share is going to be 14%. We've consistently been above that benchmark. As you can see, over the last 3 years, we did lose a couple percentage points in wholesale, but we went up a couple percentage points in internet, which has a better gross margin. Towards the right side of the slide, you can see the current state of things. And our biggest competitor right now for market share is ABJLO Solutions. They have a larger volume capacity, but charge a lower price point. However, so that is something that, going forward in future years, ABJLO, along with Go the Distance and Champions, are people that we monitor very closely for market share. Another component of maintaining this market share, obviously, is advertising spend. And if we hop to the next slide, we can look at that. So you'll see on this slide that, in year 17, we did not have any search engine advertising spend. However, when we incorporated that into year 18, we did see a 2% bump in our market share in that segment. You can see currently we are in second place for most market spend in the industry, but that is justified. I mean, we have maintained marketing expenses at about 20% of revenue over the last 3 years. Additionally, we also incorporate celebrity appeal into our promotional strategy. Right now, we are holding a celebrity appeal rating of 115 points, and our spend right now is $4.6 million in year 19. Lastly, I'd like to touch on corporate social responsibility. Perfect, thank you. So at the very beginning of the game, we activated all of the initiatives that we could possibly activate. So ethical training and enforcement, cafeteria, on-site childcare, ventilation, lighting safety, supplier code of conduct, charitable contributions, energy efficiency initiatives, and recycled boxes. We felt that it was very important, especially given the multiplying factor, to boost our brand reputation by staying well above the industry average spend for the beginning of the game. In year 17, we spent $5.3 million on corporate social responsibility, and we did win the award for most spend in the industry. In year 18, while we actually increased our spend, so did the rest of the competitors. So the industry average moved up. We didn't win the award that year, but however, we were still well above the average spend. In year 19, you'll notice that we've reduced our spend to go back into the average spend in the industry. The reason being is that we've maxed out our image rating at 100 for the past several years, and we have a very high SQ rating, which is carrying more of the weight of keeping our image rating at 100. So as a business decision was made in order to meet and exceed investor targets such as bottom line net income and earnings per share, to reduce some of our corporate social spending, to improve our bottom line margin, right? However, this is something that we need to continue to monitor going forward as other competitors continue to increase spend in this area. we will definitely want to be at least at average or higher. And likewise, if we see our brand reputation for some reason start to dip, we would need to consider increasing our spend even more in this area. But for right now, we still hold a 100 image rating, so we were able to save a little bit on the expense side. And that is my piece. So I will pass it on to Vincent. Thank you.
All right, thanks, Pat. So production strategy. In year 17, you'll see that our production capability was 8 million pairs in North America, 7.5 million pairs in Asia Pacific, and 3 million pairs in Latin America, for a total of 18.5 million pairs that we had capacity to make in that year. Our nearest competitors had similar numbers. Now, in year 18, our production capability was the same, essentially, as year 17. But you'll notice in year 17, 2 out of 3 of our nearest competitors made significant investments to try to catch up to us. Next slide. So by year 19, our production capability was also very similar to before. We made very subtle adjustment. North America was 8 million pairs, and Asia Pacific, we adjusted from 7.5 million pairs up to 8 million pairs, a difference of 500,000 pairs. And Latin America, we had a capacity of 3 million pairs, and that made a total of 19 million pairs worth of capacity, only up 500,000 in the years sampled there. Again, 2 out of our 3 nearest competitors made significant improvements. I'd just like to state that we made a decision early on that we were going to invest in appropriate space and production improvements and new equipment early, so that we would just operate like a well-oiled machine, and we only had to make subtle adjustments there at the end. Okay, so next slide, please. Our company utilized a differentiation strategy and took pride in providing stylish but quality products. And we had success charging prices on the higher end of the industry, although we weren't the highest, but we were very competitive in pricing. But really, honestly, we would not have been able to accomplish this without our great employees' contribution. We believed in training and paying our employees well. The result of this belief is we have well-trained and happy employees that produce for us. And you'll notice in the chart in front of you that in each year's sample, we compensated our employees well above industry average. And in return, you'll also notice that in each year's sample, we got well above industry average in workforce productivity. We didn't have a plant in Europe and Africa during this time period. We didn't participate in that market. Next slide, please. So in the Asia Pacific market, we had similar results. In each year's sample, we provided a compensation package for our employees that was over the industry average, while gaining above industry average workforce productivity. And lastly, in Latin America, we utilized the same strategy and reaped the same benefit. Our company is proud to have created a workplace environment where people are happy and productive. And now we'll hand it over to Joseph for the financials.
Perfect. Thank you, Vincent. For dividends, we didn't give out a dividend at any point in our operations. We figured that since we're a new business, we had no incentive to give out a dividend. Also, we didn't know how profitable we'd be as a new type of business, so we figured we'd forego giving a dividend for the first part of our operations. But I like the financial position that we're currently in, so we're looking at it in the future, but there's no answer to whether or not we'll do it yet. For stock repurchases, considering we were offering high quality shoes, we could afford to charge a higher price. We used the residuals from those profits to repurchase shares throughout our operations. As you can see from our last 3 years, we made significant uses of our extra funds by purchasing a great deal of shares, these being 1,365,000 shares in year 17, 650,000 in year 18, and 1,220,000 in year 19. Note the large cash expenditures for these repurchases. We had to expend a great deal because our share price was one of the top performing in the industry. We figured that we could continue to purchase these shares regardless of the price because it helped us vastly increase our earnings per share, return on equity, and stock price. Profitability ratios, these are used to check a business's capability to create earnings relative to its revenue, operating costs, assets, or equity over time. For the gross profit margin, the gross profit margin shows the amount of profit made before taking into account different costs such as selling and administrative. Our gross profit margin for the years 17 to 19 was 51.9%, 55.5%, and 56.8%. As you can see, we had stabilized gross profit margin, and it continued to grow throughout the years. This means that we had significant portions of profit to cover the costs that we had. While we were not number one in this metric, we always were in the top 3 throughout the industry, and we were keeping close to ABGLO Solutions throughout the 3 final years because they were the top performing in this area. Operating profit margin. This margin illustrates the level of profit that exists after a firm's covered its variable costs, such as raw materials and wages. A company will want to see a higher operating profit margin. Our operating profit margin for years 17 through 19 were 25.6%, 26.5%, and 28%. We had the highest operating margin in year 17 and the second highest in the next 2 years. Our operating margin continued to increase throughout the years. This illustrates that we always covered our costs and had additional funding to use for paying off debts or to give back to our investors. For net profit margin, this illustrates the extent to which net income is generated as a percentage of revenue. This is one of the most important factors for a firm's financial health. Our net profit margin for years 17 through 19 were 17.3%, 17.5%, and 19.2%. In year 17, we had the highest net margin and the second highest in the following 2 years, similar to our previous margin. Considering our steady growth in net margin, that should be a good sign for our financial capabilities that we're garnering through the usage of our sales. For the leverage ratios, these are financial measurements used to determine the ability of a firm to meet its financial obligations. The debt to asset ratio, this is a ratio that gives understanding into the leverage that a firm has compared to others in the industry. Our debt to asset ratio for years 17 through 19 were 0.33, 0.22, and 0.27. While we were never in the bottom of the lowest debt to asset ratio, we had a good ratio compared to the level of long-term debt that we were taking on. Considering the degree to which we were financed by debt, our ratio never got near the one mark. Usually this is indicative of a company that has more debt than assets. This puts them at increased risk to default. And since we were paying off 10-year loans in 1 to 2 years, it was more than fair to say that we had a good debt to asset ratio. The debt to equity ratio is a ratio that shows the degree to which a company is funding its operations through its funds or they're using debt. The ratio gives a good understanding into the degree to which a company could cover its outstanding debt in the event of a downturn in operations. Our debt to equity ratio for years 17 through 19 were 0.50, 0.28, and 0.38. Again, we've been relatively aggressive when it comes to taking out long-term debt. As CFO, I figured I'd opt to take a 10-year loans because they weren't costly and didn't impact our investor metrics. Taking these into account, I went with using long-term debt as opposed to issuing new shares of stock. As a result, we are likely to have a higher ratio when compared to others in our industry. However, we've made the best use of leverage as we maintained our spot as the leading company throughout the past 3 years of operations. Next slide, please. So earnings per share is found by dividing net income by the number of shares of a stock issued by stockholders. Higher EPS shows that a company is earning more net income per share of stock outstanding. As you can see, we maintained the highest EPS for year 17 at 12.27. We continue to grow our EPS. It rose from 12.27 in year 17 to 13.31 in year 18, and then it rose again to 16.52 in year 19. We lost our dominance in this area to ABGLO Solutions in the last 2 years. However, we've still been able to grow our EPS over the past 3 years, so it shouldn't be too worrying. Return on equity is found by dividing net income by the average amount of shareholder equity investment expressed as a percentage. Higher ROE values illustrate that a company is earning more after-tax profit per dollar of equity provided by shareholders. At no point throughout the past 3 years were there any company in the industry that had a higher ROE than we did. We had 30.4% ROE in year 17, 34.6% ROE in year 18, and 40.8% ROE in year 19. Using ROE as an indicator of growth, we've steadily been increasing it over the past 3 years. We've had little equal when it comes to this measure. So again, we're performing well above expectations for our financial performance. Next slide, please. For stock price, the company's stock price is determined by a multitude of factors. These factors may include earnings per share, return on equity, credit rating, revenue growth, and the firm's ability to outperform expectations. While we had the highest stock price in year 17 when compared to others in our industry, we dropped to second in the past 2 years, but we were still able to consistently raise our stock price over time. Our stock price went from $282.64 to $299.96 in year 18 and $363.99 in year 19. It was thanks to consistent efforts that I put in to better understand the competitive landscape that we could make a better strategic decisions moving forward. Next slide. And Vincent will be doing the SWOT analysis.
Thank you, Joseph. Okay, one of our strengths is our consistent high SQ ratings. Our rating was one of the highest during the entire 10-year run. An opportunity that comes from high SQ ratings is the free exposure in magazine and newspaper articles that's provided by the International Footwear Federation. The IFF rates each company's styling and quality and gives free promotion. It is a fact that many consumers are well informed about SQ ratings and consider this when purchasing their athletic footwear. So it is beneficial to us to have high SQ ratings, and ours were some of the highest in the industry. Another strength of ours is our extraordinarily strong financial position, which Joseph just talks about. This gives us flexibility to be able to raise finances, whether it be through equity or loans. We can decide. This allows us to expand our facilities and build new facilities in the future to help meet the rising demand opportunities in the areas such as the Europe, Africa region, where we currently have no distribution facility. Fortitude is also proud to be able to provide competitive compensation for our employees. We value our employees, and we believe that a properly trained and well-compensated employee will provide above average production. This has been proven to be true as demand opportunity has risen steadily for several years in a row, and we haven't had problems meeting our demand. Next slide, please. Thank you. One of our weaknesses is the inability to establish an alternative strategy. Fortitude shoe supply is subject to high intensity rivalry levels in our industry, and without a successful change, copycats and imitators could eventually catch us. Our lack of product diversity is another weakness. We sell athletic shoes only. There's a huge market for wearable smart devices that read things such as heart rate or distance traveled or calories burned and so forth. Apparel is also something that our company could look at. Being creative and bringing new products to the market, utilizing our well-known brand name will help us to diversify our market niche and can make the threat of strategic adaptability among competition more difficult to attain. The last weakness cited is our dependence on wholesale and retail markets. Most of the shoes we sell are in these markets. And with the threat of supply chain disruptions, economic uncertainty, and evolution of the market, we could relieve some of these threats by focusing more on our internet and private label segments. A little balance in these areas can help us to negotiate better retail contracts and that will help us to cut costs, which we need to do when there's economic uncertainty in the air. Thank you.
All right, thank you, Vincent. For future strategic plans, looking forward, right now there's a saturation for the companies producing high quality, high price shoes. We may have piloted the strategy, but champions and go the distance companies are trying to replicate our strategy. They're having success because they're offering similar shoe in terms of quality, but for a cheaper price in 3 out of the 4 regions, which are North America, Asia Pacific, and Europe, Africa. Having this level of competition isn't good for us in that it splits the market share among the 3 of us, allowing companies like ABGLO Solutions to have success because they're experiencing very little competition. As such, we are determined to make changes to our business model. We're looking toward working toward downsizing our model coverage from 500 in all regions to a few models to capitalize on the unexplored areas of the market. Changing up our business strategy may allow us to make changes to our marketing, pricing, and production strategies. It is difficult to look into the future to see exactly what we'd like to do. However, having severe competition is something that we do not want moving forward into the future. Building capacity in Europe, Africa region. We never built capacity in this region because of the tariff costs to ship into the region were never as bad as they were for the Latin America region. However, we should still try to create here if we're given the opportunity to better manage future costs that we could otherwise mitigate. Besides the cost of shipping into the region, there are currently 3 companies that have built facilities in Europe, Africa, and those companies are ABGLO Solutions, Champions, and Exlius Footwear. We do not want these companies to be the ones to take advantage of these facilities. If we can work to make their perceived advantage less advantageous, then we should take this opportunity. On top of all this, we would benefit from producing directly in the region to illustrate that we are dedicated to producing for the people of that region directly. This goes a long way in showing that we've streamlined our business model that will apply to everyone equally. Increasing capacity in North America and Asia Pacific, it can be difficult to see exactly what to do with any business decision. If we're to maintain the current level of models that we have now in the regions of North America, Asia Pacific, and Europe, Africa, we'll need to continue to increase our capacity in the regions that we already have operations in. This will be advantageous to work towards not allowing ABGLO Solutions their domination in the capacity construction. It will also help in sending our shoes to wholesalers in the region directly, having a facility that can produce enough of them in the region. This will keep costs down. If we decide to limit models, then we'll have enough space because we won't need to utilize as much facility space. We'll have to weigh the pros and cons of each of the decisions as it can deeply impact our business strategy going forward. And finally, making changes toward the structure of our management. Throughout the course of our operations, we had some issues with our management engaging with the responsibilities and crafting decisions to better position ourselves in the market. Moving forward, there needs to be focus on how to maximize our strengths and take advantage of potential opportunities and directly take into account our weaknesses so that we can mitigate the looming threats that have been following us for the past 4 years. If we fail to change our management strategy, then as CEO, I'll be forced to make decisions I deem necessary for the betterment of the company. Next slide. For funding requirements, the capacity expansion, per the values on our financial statements, we're planning on expanding capacity in North America and Asia Pacific regions. We're adding enough facility space for 3 million additional pairs for the North America facility and 1 million additional pairs for the Asia Pacific facility in year 20. The North America expansion will cost around $36 million and the Asia Pacific will cost around $12 million. Considering the cost, we figured our cash reserves would easily cover these expansions. Seeing as the 1 million pairs is relatively small, we decided to increase that by another 2 million pairs in year 21. This will cost an additional $24 million. An expenditure this low can easily be covered by our excess cash. As such, we're planning on using cash to fund this investment, along with the increases to our current facilities. We plan on creating an active facility in the Europe, Africa region as well to begin construction for enough space for 3 million additional pairs of shoes. Seeing as the expenditure will only be around $54 million, we'll also use cash to fund this expansion. It is difficult to predict exactly the level of cash that we're going to possess, projecting out multiple years. We'll also take out long-term loans if necessary to cover these infrastructure investments. Next slide. Stock repurchases, per the values again on our balance sheet and statement of cash flows, we predict that we'll be repurchasing 343,000 shares in year 20, 964,000 shares in year 21, and 916,000 shares in year 22 at a respective cost. Associated with each of these are $124,722,000, $378,833,000, and $388,968,000. The expenditure for the stock repurchases in year 20 can be funded by cash. However, we'll need to look forward to taking out 10-year loans for both stock repurchases following year 20. This is because it is difficult to predict the level of cash we'll possess in year 21 and beyond. Plus, we are in an environment in which steep competition is restricting us from gaining additional funding and market share necessary to take out large sums of debt to fund our future operations. Next slide. And finally, our performance targets. The projections for future performance are simply slight increases to already established numbers in year 19. This is because there's a lot of unknown factors moving forward. We've got to consider changes in the business model and how that could impact our policies going forward. It'd be hard to say that we'll continue to outperform our current values in large part because of the ambiguity associated with future changes. As such, earnings per share and return on equity will increase or will have increases of $1 from each previous period, going from $19.52 in year 20 to $20.52 in year 21 and $21.52 in year 22. These values, while conservative given our performance, they should far exceed what shareholders' expectations should be. Using the targeted weighted average cost of capital and the growth rate derived from the free cash flow growth, we calculated the horizon value, and using the horizon value, we were able to calculate our intrinsic share price projections for the next 3 years. Given how well we've been performing, I believe that these values illustrate to our investors exactly what market value is given to our shares over the next 3 years. These being $464.24 in year 21, $509.43 in year 21, and $563.69 in year 22. While these numbers are accurate given our previous track record and speculation as to our success, our conservative numbers for EPS and ROE can definitely decrease these values. However, we'll work to ensure that, that we are prioritizing the needs of our shareholders first and foremost. This concludes Fortitude Shoe Supply's company presentation. Thank you all for viewing.